Talk oil and energy. All right, first up, we got earnings out of ExxonMobil and Chevron. Both were out today. ExxonMobil had one of its highest ever profits, fueled by Pioneer Natural Resources, boosting output. Now, Chevron did miss estimates. That stock, they're both down. Chevron's down a little bit more. Chevron missing mostly because of weaker margins in refining. And maybe a bigger headline, Chevron is leaving California after 145 years. Too high regulation, other issues as well. 2,000 people probably moving to Houston, California, losing another big company. Could be tough for the area. Now, also with oil prices are down today, even though tension is rising in the Middle East. And the real threat of an attack by Iran on Israel this weekend. Let's find out maybe why we're not seeing more of a pop. Bob McNally of Rapidan Group. Bob, I'm guessing we're not seeing a pop because you and I have talked about this many times. Unfortunately, in the last couple of years, there's always now some kind of a threat, and it feels like there's just plenty of oil to counter anything. We don't need to have $100 oil. What's your take?
Right, Brian. You know, the humans and the machines that trade oil are forward-looking. And when they look forward, they see macro calamity and risk. The unemployment miss this morning being the most recent example. They're very attuned to that. And that's why we saw crude sell off. When they look forward on the geopolitical side, they don't see anything. What they hear is the village boy crying wolf. In other words, you get these sporadic escalations between Israel and Iran. You get a little bit of a pop, like we got a few days ago, and then it goes away. And so, look, we're not disagreeing so much. I think the odds favor a sort of a bigger repeat of April. The Iran will strike back, but rubble will bounce, and most likely and hopefully Israelis won't die. However, the risk of escalation is not 0 or 5%. It's more like 35%. And you know, Brian, the village boy who cried wolf, that story did not end well for the village or the boy.
Yeah, and that's it. And it's exactly kind of how I phrased it, speaking with somebody earlier today. There's a not 0% chance. And let's hope that none of this happens, Bob. But I guess the idea is Iran, literally Iran, maybe not even Hezbollah, launches a bunch of missiles like they did recently at Tel Aviv. Tel Aviv defends them. At some point, if that happens again, Israel will say enough is enough. And if they start to lay waste to some of Iran's money, which is pretty much all oil, what then with the price of oil?
It'll go up. The market will be shocked and it will go up. Look, the Houthis killed one Israeli in Tel Aviv with one drone. And Israel responded by torching the port of Hodeidah in Yemen, blowing up a power plant and storage facilities. So Israel's in sort of a three eyes for one eye mood right here. And so, look, just as the protagonist 110 years ago in Europe didn't want to enter a big war, a long, costly war. No one wants that. Iran doesn't want it. Israel doesn't want it. Certainly President Biden doesn't want it. But you can't always get what you want. And we are in an escalatory dynamic, and we're still climbing up those rungs.
Outside of that, let's all pray it doesn't happen, Bob. Fundamentals alone right now. Looks like the trend is lower for prices.
Yeah, fundamental data, Brian, coming in do not justify lower prices, in my view. Look at May. We got just hard data for May, blockbuster strong in the United States, including for gasoline, the highest since 2019 in May. We don't have any sign of a peak and collapse in demand there. Europe, not even so bad in gasoline. Yes, China. Yes, distillate is weak, but gasoline globally, jet globally, petchem globally, not weak. And we're seeing stock draws, too. Brian, in Cushing and other places. So, look, it's not super bullish, but it doesn't call for a massive sell-off in oil prices, in my view.
Okay, good stuff. And obviously, we'll see what happens with OPEC December 1st in Vienna. Maybe we'll both be there. Bob, thank you very much.